This is good news for Ford, right? Their sales, their hybrid sales led by the Ford F-150 are starting to pick up pace, but they're still light years behind Tesla.
When we talk about the cash burn rate of the company, whether or not they would potentially need to raise more capital, even though they do say that liquidity is sufficient through 2025, I think that's one of the worries, one of the risks that the street is viewing when it comes to Rivian.
It's a really struggling business. I mean, rarely do you see businesses that, stay around for a long time that have negative 200% margins. I mean,
electric car sales are on the rise in the U.S., and it's true outside of California as well. According to Bloomberg New Energy Finance, in 10 U.S. states, EVs represented at least 10% of all new passenger car sales in the first half of 2023.
All that and more. So let's get to it.
Taking a look at some of the latest reports and sales data that we got from Ford. Actually, a little better than GM. But what are you watching when it comes to all these automakers and the UAW strike, too?
Hello, Nicole. Yeah, it's amazing that Ford is claiming good news. Why? Because they posted third quarter sales of 34,861 vehicles, up 41% for their hybrid sales. When you think Tesla stock sold off with what was the number? 400,000 cars. So if you think about it, Ford, this is good news for Ford, right? Their sales, their hybrid sales led by the Ford F-150 are starting to pick up pace, but they're still light years behind Tesla, Nicole, as you know, and they have a looming strike where Tesla does not have those headwinds in this company. So Tesla's rallying today. Ford is actually down on this news. So it's a bizarro world day in cars. The company that came out with good news is down. Tesla, that we thought had disappointing news, that stock is up, about 4%, up almost $10.
The stock market is a fickle beast. Trying to understand it is equivalent to having 10 wives, trying to satisfy them all. There's only so much time in the day to dedicate to it. Unpredictable, unrelenting, and forever changing.
Shift gears a bit and talk about EV maker Rivian, because those shares on the move this morning. Now the move coming after the company saying that sales in the current quarter would be slightly lower than expected. We're looking at a loss of just about 13%. Now they also said that they would issue $1.5 billion in convertible notes, debt that can be turned into shares, which has the potential to dilute holdings of current owners. Bittersweet, though, week for the company. Now, Rivian beating their quarterly delivery estimates. So I guess some signs of some relief here, at least earlier in the week for Rivian. But obviously, lots of questions just about the path forward for this company, what exactly that's going to look like. When we talk about the cash burn rate of the company, whether or not they would potentially need to raise more capital, even though they do say that liquidity is sufficient through 2025. I think that's one of the worries, one of the risks that the street is viewing when it comes to Rivian. Truist coming in saying that they actually see this as an increasingly positive setup into the third quarter print, just in terms of what we could see here from Rivian in the coming weeks. But you see a loss of 13% on shares today, so certainly there's still a lot of worry out there.
Now, I know there's a lot of people out there that would like to compare Rivian to Tesla. So what I like to do is compare it with the platform. R1 platform is very similar to what the Model S and the Model X should be. In theory, they probably should be a little bit better. They're probably more geared toward volume production than the Model S and the Model X were back in 2014. As we know, the R1 platform moves slower than dog shit. On pace to make 50,000 of these vehicles this year, hopefully. So you're looking at trying to compare a company of today to a company back a decade ago. It's just not logical. And it's true, it took Tesla a long time to become cash positive. But the main difference that separates Rivian from Tesla is the many hats that Tesla tends to wear. Sure, they're selling cars, but they also have a robust energy division. Software that is definitely unmatched in the industry. Tesla is producing batteries. They're in robotics. All of these things emerged after the second generation platform was well underway, but they were still thinking about it prior to that. It's been a part of the plan. Beyond building cars, I don't think Rivian has any other plans to do much else.
And this coming the same week that we had just got some of those delivery production numbers for Rivian that we'll hear once again when they fully report earnings. But for the quarter ending September 30th, they had produced 16,304 vehicles at that manufacturing facility in Normal, Illinois, delivering 15,000 and a half of those, just a little bit more of that over the same period. So all of this said, that's roughly in line with expectations from what the company has said. We're going to be looking out for earnings to come on November 7th after the market close, but it's really just about making sure that they do have that liquidity, to your point, to be able to continue to produce these vehicles. And of course, for Rivian, I don't know, I've seen more of them around New York, more than...
That is true.
Yeah, there's a few of the facilities, and of course the model now that many of the car manufacturers, especially in the electric vehicle landscape, and really disrupted by the way Tesla goes to market and how they entered into the market as well. It's just basically a shop, like a storefront, basically, where they've got a bunch of these lined up. It's not your traditional dealership where you walk in and you see about 15 different models, and then they've got about 1,000 of them downstairs somewhere or even on a lot. This is different, and I think that for that experience, it's been fascinating to see where they can go more outside of just this dealership model that many of the legacy automakers have powered for decades at this point as well.
Yeah. Many of their models, though, they're pretty expensive.
They are pretty expensive, yes indeed. Pretty penny.
Well, they gotta be expensive because they cost an arm and a leg to make, at least right now.
Rivian stock has been under some serious pressure today. The company announcing plans to offer $1.5 billion convertible notes. David Trainer's with us, CEO of New Constructs. So when you see Rivian down 20% today, I mean, it's a huge move. And the company now, the offer of convertible notes, that's something here. I mean, the truth of the matter is Rivian could have some liquidity issues, and it's burning through, my understanding, $1 billion per quarter, according to at least one analyst I spoke to today. What do you think about what they're trying to do here?
And they're trying to stay alive. And we put them on the zombie stock list over a year ago, almost a year and a half ago, because they don't make money and they didn't have enough cash just to keep them around for more than a couple of years. So at some point in time, they're going to have to do this. And the stock's down because it's a terribly dilutive event for existing shareholders. Beyond that, though, the stock is still ridiculously overvalued, and it's a really struggling business. I mean, rarely do you see businesses that stay around for a long time that have negative 200% margins. I mean, it's a struggle. I'm not saying it's a bad vehicle. Look, I mean, it's probably a great deal. You're buying below cost, right? Just like the early Model S's, you got to buy those below cost. But yeah, we struggle to see how this stock is really going to be able to give investors much upside from here.
Yeah, I mean, when you see how they are burning through cash, as you noted, you had them on the zombie list from a long time ago, and that was something that you saw as a flag. I mean, when you looked at the cash burn rate and the cash on the balance sheet, is that something that you would use to determine what goes on the zombie list?
Yeah, absolutely. All the stocks on the zombie stock list have less than 2 years of cash runway. They're burning so much cash that their current cash holdings can sustain them for less than 2 years. Sometimes it's a lot less than that. And for most of those stocks, they've all seen really precipitous declines, and most of them have been forced to drastically cut costs or raise new capital. But it's obvious if you're doing the fundamentals, you're looking at the fundamentals. It's pretty obvious. If you want to believe the narratives, you can make a case that pigs will fly and Rivian will sell. I think the current stock price implies they're going to sell more trucks than Ford sold F-150s in 2022. That's what you got to do to justify around $19 a share. That's like 750,000 plus cars, more than 2% of the entire electric vehicle market. And again, more than the top selling truck in the world, Ford's F-150, more than what they sold.
Yeah. As I look at the big three, and obviously the strike continues, GM actually has less cash than Ford and Stellantis. That's one issue. Also, GM has secured $6 billion credit line just in case. There is some concern there about GM versus Ford and Stellantis. What do you think about that, Stellaris?
Yeah, Nicole, I mean, we're bullish on the legacy automakers. They're not burning through tons of cash.
What? But I get it. Their stocks are a little bit lower than anticipated, especially with the strike being baked into their stock price. A potential opportunity? No? No? Okay. Maybe later. Bullish is a strong word. Rivian will be profitable in the automotive space sometime next year. And they are burning through tons of cash, but they're going to need to get the R2 platform up and running. What does Elon say? If you're going through hell, don't stop. Give him that little Diddy shoulder bounce. Can't stop, won't stop. You have a chance to carve your name into history by being one of the top electric brands in the future. Saying you're bullish on the Detroit 3 kind of makes me chuckle inside. Whenever a company has a dying part of their business, and trust me, internal combustion engines are dying. Hybrids are the last stop on that train. And once people realize that those are kind of obsolete, game over.
They've been more cash flow profitable than anything else. That's part of why they're having a strike, is that the workers have said, listen, you guys are making too much money. You need to share some of that with us. I think they'll figure that out. And I think that they will be major players eventually in the electric vehicle market. And we're going to continue to see what New Constructs has been saying for 5+ years, which is as the electric vehicle market matures, you will see market share distribution similar to what you've seen in the legacy auto market. And the valuation of these EV startups are going to get crushed. And most of them, just like in the legacy auto market, most of the EV startups will go out of business. They won't survive. Most of the original car companies are no longer around today. And so the valuations in these EV companies are really risky, and we really definitely think investors should avoid those stocks and look for better values.
Electric car sales are on the rise in the U.S., and it's true outside of California as well. According to Bloomberg New Energy Finance, in 10 U.S. states, EVs represented at least 10% of all new passenger car sales in the first half of 2023. Andrew Grant, the group's head of intelligent mobility research, joins us from our London office. And Andrew, I mean, this makes sense, right? Because as some on the right would say, the government is shoving them down our throats, subsidizing them heavily, and really trying to push EV sales. So is that working?
I mean, the early stage of any market, you need a bit of policy help and a push to get it going.
Let's agree to disagree. Battery electric vehicles are a commercial inevitability. They need no government assistance in this transition. All it does is provide the makers of internal combustion engines a bright neon sign. You need to be zagging. That zig ain't cutting it no more.
From our experience, we've seen that once you hit a certain threshold with electric vehicles, you can start dialing back on some of those really heavy-handed incentives, whether they purchase incentives or other financial structures, and then let the market start taking care of itself. Now, I'll mention China, for instance, which in August had 38% of the passenger car sales being of the electric variety, both plug-in hybrid and fully battery electric.
What? Listen to that. That's 38%. Now I know it includes hybrids, but that is a stepping stone. I myself had a hybrid in 2019. A stepping stone for me to hop my ass in a Tesla. It is my humble understanding that many individuals will choose the hybrid option prior to choosing their electric vehicle. As Spock would say, it's only logical.
And that's after they've removed a lot of the purchase incentives. So, yeah, it seems there is a threshold that can push this market forward.
Right.
But all regions and all segments are going at different rates.
I mean, in China, there are over 100 EV producers, right? So a lot of the market, that's the supply there. The question is, what's the demand look like here in the U.S.? And you know, a lot of people expected 5% to be the tipping point. Now I guess we're looking for 10. It keeps getting pushed back. When is the point at which you can take away what, at least in this state, are currently subsidies totaling almost $10,000 per vehicle and still expect Americans to buy these electric vehicles?
The only clean answer for you there is it depends. It depends on which segment you're talking about. It depends on which states. It depends on the income and GDP per capita in different states. And even some information that we found around the political leanings within a certain state will influence how electric vehicles are adopted.
Let me break this down in simple terms. There are 3 things that consumers care about. First and foremost is price. price has to come down. 2, range anxiety. There's a combination of the batteries needing to be able to go so far on a single charge and having a charging infrastructure that is laid out across that region. And 3, it's availability. Tesla plans to make 1.8 million cars this year, globally. Let's just think about how small that number is when you compare it to the top 5 states in the United States. Simply put, there's not enough EVs to go around. This tipping point, the more EVs there are available for purchase, the more EV sales there will be. Trying to predict exponential growth is a fool's errand. That's why EV manufacturers just need to be as many vehicles as possible. And thank the maker that Tesla had the foresight to build a robust supercharging network across the planet. I didn't know how hard this was until I went to an EVgo charger and realized 90% of those things are busted.
Well, the love for hybrid cars might be seeing a new surge in popularity as pricing and weak charging infrastructure appears to be deterring consumers from purchasing fully electric vehicles. According to data from Global Data, U.S. hybrid sales have more than doubled since 2020, seeing a 35% increase in the past year alone.
That should be an alarm bell. Like I said, hybrids are the natural stepping stone to pure battery electric vehicles for consumers. This number will rise alongside the pure battery electric vehicle numbers, but mark my words, the hybrid number will peak and then drop precipitously, fueling the increase of battery electric vehicle adoption. That graph is going to look like an implosion when you're talking about hybrid vehicles.
And hybrids have also continued to outsell EVs in the US, approaching 1.4 million vehicles in 2023, commanding 9% of the car market compared to the 1.2 million in electric vehicle sales and control over 8% of the market. But are hybrid cars truly more cost-effective than fully electric vehicles? Well, the Idaho National Lab has found that even though hybrid cars are more expensive initially due to the need for a larger battery pack, they are economical, saving owners long-term on fuel costs. Now, Kiko, I know you're an EV person here. I'm one of these people who's sort of been teetering on the edge here, debating whether or not I'll go sort of the plug-in hybrid or the traditional hybrid that sort of charges as you go, or just sort of biting the bullet and going full EV. When you think of between the tax breaks and some of the benefits, it makes sense that people want to hedge their bets and go for a hybrid.
Yeah, because you get the best of both worlds right now, right? I mean, the range anxiety is real. It's not necessarily that these EVs don't have the range they do. It's that the infrastructure just isn't there. And unless you're driving a Tesla, which has really a very reliable network, it's just tough to make that switch for a lot of drivers.
Your mother right. My range anxiety has been cured. Probably why so many car companies are putting the NACS on their vehicles. Nah, it's just a coincidence.
To your point, when you're talking about plug-in hybrids, at least, they do still qualify for that $7,500 IRA tax credit. So interesting bet there in terms of where drivers are going. I mean, that also points to just how drivers are still thinking a little more long-term. I mean, EVs are where the market's going, but when you think about where fuel prices have been, still painful to go for an ICE car completely. Plug-in hybrid seems to be a good compromise, at least for drivers who are looking to save a little money right now.
A natural stepping stone before you get to the battery electric vehicle.
It's true, and you kind of have to balance it because you also sometimes will get charged more in terms of car insurance because, you know, EVs and hybrids, it's more expensive to fix. And so it's trying to, you know, balance some of these considerations while you're trying to, you know, balance your checkbook, balance your wallet in a high interest rate environment. So a lot to consider. I'm still leaning towards a plug-in hybrid. I'll keep you posted.
Yeah, I mean, maintenance costs, though, are almost non-existent when you think about EVs compared to an ICE car. So there's that benefit as well. But it really, at the end of the day, it is a comfort level. And the reality is the infrastructure just hasn't followed yet, at least for 100% electric vehicles.
It's okay. You're not comfortable enough with a pure battery electric vehicle, but you're gonna get there. Maintenance of a hybrid is even more complicated than maintenance of an internal combustion engine. You have all the nuances of an internal combustion engine, yet you have this larger battery that is supposed to be able to be propelling the car forward occasionally. More parts, more complexity, and you don't expect the maintenance costs to be crazy? As far as insurance goes, Tesla has that wrapped up as well. Another feather in their cap for why you should not only go electric, but you should be driving a vehicle with the Tesla logo on it. Demand versus production versus affordability. Tesla's just in the best position to play the game.
Automaker Hyundai, like Sunday, they announced that they're going to adopt Tesla's charging plug, also known as the North American Charging Standard, starting in the fourth quarter of 2024. This is just the latest car company to make its vehicles compatible with the charging standard. It's a big win for Tesla. Its superchargers were once exclusive to owners of their own car, but recently started offering access to non-Tesla EV owners. And I mean, you really round out as we were kind of taking a look at some of those other major companies that have signed onto this new standard. It's been a significant way forward for Tesla here, but for GM, buy-in from some of the largest US as well as European manufacturers, that's certainly a way forward, at least perhaps providing some clarity as to where consumers who are opting into more electric vehicles can find a standard or make sure that their car is compatible with so many other chargers as well.
Yeah.
I can't wait to start seeing all these vehicles at the Tesla charging stations. Maybe that's because I charge at home mostly, but it will be nice to see what these other consumers of battery electric vehicles and how they like the Tesla network. Oh, there you go. Is it because this is basically just free advertising for Tesla at these charging networks? People pulling up in Mercedes, Nissans, GM, Ford, what have you. They're going to be surrounded by Tesla customers. Basically a real life commercial playing out in front of their eyeballs while Tesla stands to profit while they refuel their inferior electric vehicle? Yeah, I guess that's an opportunity. In conclusion, the stock market is weird. Don't expect to predict its direction with any meaningful accuracy. Good news, bad news, who cares? 85% of its operation is automated. Who knows what those bots are thinking? Just place your bet and let the roulette table spin, folks. Ford's Q3 numbers are a little bit better than GM's numbers, but not by much. More than likely only fueling the UAW's need for the best deal possible. Talk about lagging indicators. Rivian stock took a body blow, dropping damn near 20%. Hybrids are selling more than electric vehicles, but that's no surprise there, as hybrids are a natural stepping stone to the battery electric vehicle. And Hyundai, Kia, they are the latest additions to put the NACS on their vehicles. That's all I have for you today. Be easy. Peace.